and welcome to Money Matters TV. I'm your host today, Audrey Greenberg, co-founder of the Center for Breakthrough Medicines, and my co-host is Mike Devers, CEO of Brandywine Asset Management. And we have a great guest today, Lou Kassa, CEO of the Blumberg Institute, the PA Biotechnology Center, and of course, the Hepatitis B Foundation. We're excited to talk to him. But first, Mike, we're in a new year, 2023. Dying to know what your thoughts are on the market and maybe to reflect a little bit on 2022 and what we saw.
Yeah, 2022 was a year where we went from tailwind to headwind. I think is the easiest way to describe it, where the Federal Reserve went from super easy monetary policy, where the global governments went from a large fiscal stimulus through the COVID crisis to where everybody started cutting back. Fiscal policy got tighter, monetary policy got tighter. So we went from a period where almost anything worked. And we had talked about this in some of our shows in 2021, where everything was moving up, with SPACs and cryptocurrency, real estate, stock prices. The more esoteric or speculative, the better. And that was all because we had so much money flooding the system globally. 2022, that reversed, and I see more of that reversal continuing into 2023.
So what should we be on the lookout for in terms of any new products or new ways to look at the markets? Or is it more sort of like flight to quality? And also, I guess I'd ask interest rates. What are we seeing there?
Right. So people have underestimated the level of interest rates now for the last year and a half, ever since we came out of COVID. I mean, if you go back even just a year, the interest rate predictions were for shorter term rates to be maybe 1-2%. Now they're talking about 4-5% and maybe even more. We may continue to get surprises there, not necessarily because the Fed's pushing those rates up, but just because market continues to push those rates up because of fear for renewed inflation. I think what's going to happen is anytime with interest rates is anytime we get a little bit of a rally in markets and in the economy, people are going to start pushing rates back up again. And so I think it's going to be difficult for them to come down significantly. If anything, they're going to stay elevated for a while, probably at least through 2023. Other markets, I think for the most part, you're going to have some treading water, some difficult times. There'll be periods, like in any bear market even, where you have 20% rallies and it seems like everything's turning around again. Then they'll settle off again. I think. I don't expect this to be a year like it was coming out of the COVID crash, where everything just rallied explosively. I think we'll have a struggle through this year for financial instruments, bonds and stocks, real estate, to make much money.
So what does one put their cash? I mean, it looks like, it's hard to decide how to invest these days, knowing what's to come.
It is. So I think one of the areas what you see happening over the last part of last year was move from growth stocks into higher quality value stocks, and I think that tendency is going to continue. High dividends, high value. So stocks that aren't selling at 50 price to earnings multiples or 100, or in some cases we were at multiples of hundreds with Amazon and Tesla, for example, in the last few years. I think they're going to start being priced more fairly. So you're still going to see prices come down in some of those stocks, and some of the value stocks that are producing a lot of cash, paying high dividends, are going to continue to be where the money flows into over 2023.
Yeah. Do you do a lot of international investing? And if so, what are you looking at in terms of global markets?
Yeah, so the global markets, we do. The global markets are interesting because you've got kind of a mix there with, some of the European markets are right up near their highs and made money through 2022. When Europe's in arguably a much more substantial recession mode than the United States is. So it's a little bit contradictory, I guess, is what you would say, with the price action and the actual economic activity that's there. I don't know that I expect them to continue to rally in a significant way through 2023. I think you see some sort of a normalization between what's happening in the U.S. and what's happening in some of the international markets.
Yeah, yeah. So, in terms of hedging strategy, do you guys maintain? I know you have a certain percentage of long versus short, and I'm not sure exactly how you guys do it. What do you look to change that based on the market, or what are you looking at in terms of your own portfolios?
Right. Okay. Yeah. So what we've got, we have funds that now we're rolling out an actual suite of 10 different funds that are going to cover the gamut of small cap value to large cap growth,
Oh,
as well as some international, as well as some uh, bond funds as well. And the idea with all those funds is that they provide a close correlation to the underlying index, but with protection. And we've been
right.
doing this now the last few years, but where we've been doing it with the intent that if a market's down, we may actually even be up. These new products are going to be much more closely correlated to the index, so they'll serve as an absolute replacement for a large cap fund in somebody's 401k portfolio, for example. They can replace that with one of the Brandywine products, and that gives them access to the exposure to the underlying index,
Mhm.
but with some protection on there. So it may be that the index drops 20%, and the possibility is that these drop 18. We're not trying to hit home runs and totally deviate from the performance, but the idea is that little incremental improvements and protection on the downside against big losses over time allows you to recover from higher levels and ultimately produce higher returns with less risk.
Mhm.
That's the concept. Past performance is no guarantee of future performance, as I'm always required to say. But the math is solid, and it's something we've got a large institutional pension plan investor coming in to help us launch these first 10 funds.
That's great. I didn't know about that. And you are
Yeah,
just buying calls, or what are you doing?
we're buying puts actually. So
Oh,
the funds, yeah, so the funds are protected on the downside with puts. A put option gives you the opportunity, the right to sell an index or stock at a set price over a period of time.
Mhm.
So if we buy a put option, if say the S&P index is at 4,000, and we buy a put option to be able to sell it a year from now at 4,000, then if the market drops to 3,500, we actually make that 500 point difference because we can sell it at 4,000 and we have the ability today, that day, a year from now, to buy it at 3,500. So it helps provide protection to the downside. And then there's a cost in owning those puts. So we pay for that. We attempt to pay for that through what we refer to as our return driver diversifier, which is a globally diversified portfolio of non-equity markets. It's trading
Mhm.
commodities and currencies and different things that are trying to eke out little bits of money over time to be able to pay for the cost of that put protection.
Got it. Got it. That's interesting. And you're also looking at fixed income as well, or you guys? Yeah, yeah.
We are. So that's not something we've done up until now with the protected funds, but we will be launching 3 separate funds that'll be in the fixed income sphere as well. That'll be something that's a longer sort of more benchmark 5, 10 year type period fixed income product with protection. We'll be launching one that's high yield and then one that's shorter term, 1 or 2 year fixed income product as well. So the idea is the same as with the equity products, is that, and this year has showed the need for that, where bond markets sold off, 20%, people had losses in some of these bond funds. This would help protect the downside against that type of loss.
Okay. Well, we did get an audience question. It looks like Nan Parker of Philadelphia wants to know what question should be asked before investing in a hedge fund.
Okay, so there's actually a lot of questions, and there are, I believe, if you log in to the SEC or maybe do SEC hedge fund, there's lists of questions that they have, but there's 2 primary areas that you want to ask questions about. One is operational, and the other is performance, strategy-wise. Operational is really the first place you have to go, and every hedge fund has to have the funds themselves are usually exempt from registration, but the fund management companies aren't. So you can log in and you can see the registrations, type in the name, see the registrations associated with that firm. Make sure they're registered either with the SEC as a registered investment advisor or at the CFTC as a commodity pool operator. And then they are all required to get annual audits at a minimum of their funds. Make sure you view the annual audit and that they're producing an annual audit from a reputable firm. If that, I won't even go into the performance and strategy questions that you can ask, because you have to get by those questions first. Make sure you're dealing with a legitimate entity.
Yeah, lot to know when you're investing outside of the public markets, I suppose.
Yeah.
So look, here's how to submit your questions to Money Matters TV. Feel free to do so if you're interested in having Mike or I answer a question.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
So with that, we offer our guest, Lou Kassa, a warm welcome. Lou is the CEO of a Hepatitis B Foundation, the PA Biotechnology Center, and the Blumberg Institute. And we'd love to hear about those entities. Lou, welcome. And can you tell us a little bit about PA Biotechnology Center? I know it's such a unique model, and people would love to learn about it.
Yeah, thank you, Audrey, and thanks so much for the opportunity. It's my pleasure to be here. Yes, we have a very unique model and program. As you know, there's over 200 life sciences incubators in the country. Well, what makes ours so special is that we have 3 nonprofits in the center of the Biotech Center. We've got the Hepatitis B Foundation, which is the parent organization. It's a very small but impactful advocacy public policy organization. They just do such tremendous work. Our second nonprofit is the Blumberg Institute. That is our research arm. We focus on liver cancer and hepatitis B research. Over the past few years, though, we have diversified a little bit into some CCR5 and our mRNA technology. Our third nonprofit is the Pennsylvania Biotechnology Center. And what makes our model so unique is that the Blumberg Institute manages the Pennsylvania Biotechnology Center. We are in the community. We actually have the most labs. So we have this really unique platform at the Biotech Center, anchored by a nonprofit that provides services. You know, the Blumberg provides grant writing assistance, immigration assistance, all kinds of services, safety and compliance. And we have these 8 or 9 ingredients within our model that really, I believe, makes us stand out, so much so that we've had 6 IPOs here, and we've had about $3 billion worth of company value created.
Wow. Yeah, that's impressive. The 6 IPOs. I mean, you know, that's great. I also see that you've replicated this model and you're partnering with Brandywine Realty Trust and opening up some labs at Cirrus Center. Can you tell us a little more about that? How that expands your mandate and what it is you're doing?
Absolutely. I mean, we have had this model's been in place. Our founder, Dr. Timothy Block, I have to give him so much credit for organically creating this. He was a visionary, not just a scientist, but he helped start all 3 of our organizations. As I started here in 2014, I started to see some ingredients that some incubators had, but not all of our ingredients. So I went out and visited over 70 incubators. I came back and I saw that we had this platform. We had the nonprofit. We really focus on an ecosystem that is company selection. It's the most important part of this business is company selection. Looking at the scientist, the CEO, the CSO, the IP, the funding mechanisms, VC, SBIR, angels, and then really focusing on co-collaboration and speed to market. We believe with this ecosystem and having the right companies in here, I'll even ask other CEOs in our Biotech Center for their feedback, that if we co-collaborate, it will accelerate. So much so that the national average for an early stage success, be it an IPO, revenue generating or acquisition, is about 8.5 years. That's a Cambridge Associates study. Here in Doylestown, it's 3.5 years. So the light bulb went up. Hey, how can we replicate this? And it took many years, but we found around our partners, Brandywine Realty Trust. They've been great. Jerry Sweeney, Jeff Devano, and really we're looking at that time for Schuylkill Yards to be a magnet for a lot of the regenerative medicine and cell and gene therapy companies in the country. So we opened up B Labs, it's called, and people go, why is it called B Labs? It's a very synergetic letter. When you think about Blumberg, Biotech, hepatitis B, Brandywine, it just seemed like the right name. And we opened up last January in the Sierra Center, which is located right next to 30th Street Station. It's a great location. We're on 3 floors, approximately 50,000 square feet. And I'm proud to say at this point, we're at full capacity. And it's really taken off at this point of the year.
That's great. You're so lucky. All of us really are lucky to be based in Philadelphia. What are you seeing out there in terms of some trends in the Philly area for early stage companies? You guys are catering to these early stage companies that need a small amount of space to help launch to the next level. What are you seeing out there in terms of new companies and trends?
Yeah, what really with the pandemic, we saw a resurgence in the greater Philadelphia area as far as companies becoming interested in what we offer here. I mean, first off, and I know you guys are aware, we have the talent. You know, the pharma belt goes from North New Jersey down to Philadelphia. Some could argue Delaware. I mean, that's 80% of all U.S. farmers right in our backyard. So looking at that and looking at some of the what Penn has been doing with regenerative medicine, it really opened up the door, so much so that we're now seeing, for the first time ever in Doylestown, we're seeing companies from San Francisco, Mountain View, and Boston coming into our communities. And down at B Labs, 43% of all the companies in B Labs are from outside the greater Philadelphia area. So that's a big trend we're seeing right now. Another big trend is actually a little political, but you know, the next governor and administration is coming in January 17th. Josh Shapiro, in his campaign speeches and conversations, has really made biotech and having an impact on life sciences one of his priorities. And I'm hoping within the next, within this year, we can, put some incentives and investment in place like Massachusetts, New Jersey, and North Carolina that will really put us over the tipping point, which I think we're at right now. When you look at all the life sciences clusters, we're always between 5th and 9th, depending on what given year. I think with the right state support and a couple other items that we're working on with the new $5 million grant we got, which is basically scholarships from the state that we can put in our incubators and support real early stage technologies, that could push us into the stratosphere as far as the greater Philadelphia region.
Is that $5 million going into companies as like seed investments, or what is the use of that?
Well, it's going to be really focused on, for B Labs and the Pennsylvania Biotechnology Center, the opportunities for 2 tracks. One is we have so much great academic technology in this state. I think we're 4th in NIH, 5th in patents. It will allow us to basically talent scout and see what technologies we can license out. And part of that money could provide C-suite hiring, equipment, IP management, business expenses, free lab space. So that's one path. The second path would be a very early stage company that needs those services. So we're working on right now an RFP process so that we can have at both sites get these companies in here. And this was a first grant of its kind from the state. And there were many options for the state to go to, and that they had the belief in our model, in our system. We're really honored, and we really want to deliver for them.
What else do you see that would help you continue to grow in addition to that?
Well, I really been saying, and RJ's probably heard me on my stump the last couple of years, state support is huge. When you look at the other incentives, as I mentioned, and what Mass Bio has done and what North Carolina, New Jersey, we don't have to reinvent the wheel. We can look at what those models have done, implement it in Pennsylvania. Can you imagine $1 billion investment and what kind of statement that would make and what it would do? Because all these early stage companies need money, they need investment. And then second, it's VC. VC funding in this area, I mean, let's be honest, they're sniffing around. We had some great years in 19 and 20, 21, but last quarter pitch book, basically 77% of VC investment in the greater Philadelphia area is down. So we need a couple of VCs to plant their flags in Philadelphia. And one of those opportunities is our own Hatch Bio Fund. which was created by the Blumberg Institute. And we are looking to raise a $50 million fund specifically for our 2 incubators. But we really are starting to see what I didn't anticipate is companies from across the country looking for that VC funding and coming to Philadelphia potentially to be in our incubators.
Yeah. Has the financial climate impacted the incubators at all, or the companies in the incubators? What are you seeing in terms of sort of this pending recession everyone's predicting?
Yeah, it's tough. I mean, part of the vision is to build out incubators, throughout the other life sciences clusters. I don't see that happening this year, maybe not in 24. So we're pivoting a little bit more to partnerships and maybe affiliations with other life sciences clusters that we can help out with. A lot of the early stage companies are kind of doing the duck and cover. As I said, VC funding is down. Going IPO right now, probably not the best thing with this environment. So you'll see more, mergers, reverse IPOs, acquisitions. That's kind of the vibe I'm getting from both incubators. What we are very fortunate, though, just to kind of counter that, is because of our company selection. I do believe the cream will rise to the top. There's still money that's being invested. There's money on the sidelines, and I am seeing some of our, I would say upper echelon companies. They're still receiving the funding to move forward their scientific technologies.
Yeah, that's raises a question. What are some of the companies that you have in the portfolio that you're incubating that are, developing, innovating? Can you give us some specific examples of those?
Absolutely. And I have to be very careful because it's like your children. You don't want to pick out your favorite. And I don't want to, I'll put the disclaimer out there. I apologize to anybody I haven't mentioned, but we have 50 companies in Doylestown and we have 15 companies down in Philadelphia. But public, I could share some news. Capstan about 6 weeks ago had a Series A of $175 million. Community was just bought by a company owned by Gilead. That's a very successful transaction. We have a company in B Labs called Merlin, which is an mRNA company working on liver cancer and hepatitis B research. That is a spin out of Blumberg, and our new Blumberg president, Randy Heyer, is the CEO. Randy's background is he was SVP at Moderna, and he was actually in charge of the vaccine program as far as getting it FDA approved. In Doylestown, a couple companies that are doing well. Everest is a company from Princeton that was awarded a $30-some million DoD grant to do the next pandemic work and try to be more proactive on that level. We have Fox Chase Therapeutic Discoveries. They have been working with Biohaven up in New Haven, and they've had quite a bit of success. And then finally, VS Partners is one of our regenerative medicines here in Doylestown. They've got a couple products out on the market, and they're doing very well at this time.
That's great.
So what does the future hold? What is your vision for the centers and for some of the institutes and the Hepatitis B Foundation? The future is bright. Are you thinking, long-term, short-term, and what's the strategy?
Yeah, I think all three, again, to use the child analogy, they all have the same DNA, but they all have different missions. One might go to Ivy League school, one might go somewhere else, but they all have great opportunities right now. Our founder and president, Timothy Block, retired in the summer. He really set the foundation for us to grow and succeed. And I think we have doubled all three organizations combined since 2018. I think hepatitis B, to continue to do their advocacy and public policy and maybe reach into other parts of the country like San Francisco, New York City, to make even more of an impact. They've been doing some phenomenal work with some of the legislation in Washington to make sure the hepatitis B patients are treated fairly. The Blumberg Institute is growing. I mean, all three organizations have hired 7 employees since July. Now, I know that's nothing like Center for Discovery Medicines, where you probably hire 7 people a day. But for us as a small nonprofit, it's really great to see the new talent coming on board. And as far as the Pennsylvania Biotechnology Center, I think there's two tracks here. One is to develop a biotech corridor here in Doylestown. We've had quite a bit of success over the last 12 to 15 years where we could actually have graduate program companies move right next door to the Biotech Center. Instead of having 400 jobs here, we could have 4,000. There's a lot of support from that, from all our legislators and the community. So we'll keep pushing that vision. And then the second path is, opening up incubators, as I mentioned prior, in other life sciences clusters that could really benefit from our model. I think it's so unique that if we got in the right scenario, we could help get more IPOs and more. The bottom line is scientific discoveries that help out mankind and help out with diseases. So that would be the two paths, I think, for the PABC.
Yeah, I mean, the incubator's full. Are you thinking about building out more space it's just to accommodate the need? And I know you said you have this fund that I think you guys raised a fund, right? And could you make that fund bigger to help with the incubator companies in the region?
Yeah, I mean, two parts of that. One, yes, we need more space. We would love to have another 30 to 50,000 square foot building here on campus, because we have companies. And what's unique about our model at the beginning of our interview, we don't kick companies out because we believe that the companies that are senior have know-how. I mean, we have 8 FDA drug makers that have been on site here. That's very rare for an incubator. So we're not rotating companies in and out 2 to 3 years. We believe having the senior companies help mentor the freshman companies. It's just a great mix. When they get IPO or when they get to a certain size, they have to move out, and that's where they can move into another building, which, as I said, we desperately need. As far as the Hatch Fund, we've raised, I'd say, a little bit more than half of the fund right now. We're about $32 million. We're looking to make the fund active sometime in the first to second quarter of next year. It is a $50 million fund. Quite honestly, I think it's a small fund. I think at some point, if our track record holds and we're able to have success with the $50 million fund, I'd love to see, again, vision and looking forward, $100 million to a $250 million fund, and Hatch become the premier VC fund for this greater Philadelphia area.
That's great.
That's great. Well, yeah, appreciate the insight. I do have one last question. You talk about, I mean, there are a lot of opportunities. Do you find any problem with hiring in the area with the hiring you're doing, or what other constraints might you have to meet your goals?
It's very interesting. We're getting companies that come just to the greater Philadelphia area because of the talent here. So one of the companies that moved from Mountain View, California here to Doylestown we're able to hire a lot of their top researchers and C-suite people because we're in the middle of the pharma belt. So the high-end upper echelon talent, we've been very fortunate. What we're finding a little bit of a problem, at least in Doylestown, is more of the postdocs and getting more some of the younger scientists on board because of our location. It's the opposite in Philadelphia. Philadelphia has that demographic. It's right next to University City, so they have a much better chance of that workforce. But I do believe, if we're looking at the greater Philadelphia area, making a big move, to really have an impact on life sciences, we're going to have partnerships to develop this workforce. We're not going to be able to compete with the San Francisco, San Diego's, and Boston's if we don't have a coordinated effort. And it's not just the scientific side, it's manufacturing and all the other services that go along with the successful biotech cluster.
Yeah. So what are you thinking about reflecting on your experience here? You've been doing this for some time and you're so good at what you do. What is a one lesson learned that you would communicate to our audience, like if they were thinking about either starting a biotech or maybe even starting an incubator? What would you give them in terms of something they maybe wouldn't think about but should think about?
That's a great question. I think being inclusive, really, we like partnerships. We'll partner with as many academic institutions, other incubators. I mean, one of the things, I was just at an event in June. I was asked to host a panel. I invited up all the fellow incubators and other research. I think that, what's the saying? Rivers rise, everyone rises. I think if you look at the greater Philadelphia and you look at what success we can have, there's enough for everybody to be successful. What you guys are doing down there in King of Prussia, I mean, that's a big part of our ecosystem, and we want that to be a success because we're all going to benefit from it. So my first advice would be, be open-minded, be inclusive, and create all these partnerships.
Yeah, I couldn't agree more. We should all work together to make Philadelphia the #1 region for life science. Thank you so much for your time today, Lou. Mike, you're a great co-host. So happy to have you on the call. And Lou, you're welcome back anytime. With that, we'll see you next time on Money Matters TV.